Okay, good afternoon and welcome to the 8th Annual Laurentian Bank Securities Institutional Investor Conference. My name is Nick Agostino, Head of Research and the Diversified Technology Analyst here at Laurentian Bank. My associate Salman Rana is also assisting me today, working in the background to help moderate this call. So before we begin, just one housekeeping item. Just make sure that your microphone is on mute and your camera is turned off during the presentation. And please ensure your name appears on screen so we can properly address any questions you may have. Also, if there are any questions, we will pause during the course of today's chat to take that question. Please use either the chat function at the bottom of the screen or the raise your hand feature, and we will call on you when we're ready to take that question. Just remember that if you do use the raise your hand, to lower your hand once your question has been answered. And should you experience any technical issues during this fireside chat, please communicate so on the chat at the bottom, and we'll try to tackle it as quickly as possible. And finally, we've also prepared a guide to help walk you through today's fireside chat, and this can be accessed on the LAYA tab at the bottom right side of your screen. So access that if you so wish. Having said all that, we'll get started. So join us today for the fireside chat is Paul Raymond, President and CEO of Alithya Group. So welcome, Paul.
Thank you, Nick. Nice to be here.
So we'll get right into it. Industry trends is probably the one area I'd like to start and do more of a top-down discussion. Yeah. So we've heard the idea that IT spending, Gartner is one company that's talking about a rebound in 2021, both on the software and the hardware side. Can you speak to if you are seeing that recovery and that increased spend, and how Alithya is positioned to take advantage of that recovery?
Yeah, sure. I think, first of all, when you look at the numbers, if you deep dive into Gartner's numbers and the similar reports, and even I read another one yesterday, in Canada and the US, the overall growth of IT spend is not that significant in the coming year. The big difference is there's a huge shift from where people are spending. So the area that we focus on, the digital transformation and then moving to the cloud and cloud-based solutions, is where we're seeing tremendous growth. By the same token, we're seeing like decreased spending in other areas that we don't cover around infrastructure and legacy stuff. So I think we're in a very good spot, and we're seeing it in our bookings. Our bookings of new digital transformation projects have been very good, and we've been reporting on that for the past year. And it hasn't slowed down. So no, we look forward to the next year, which just started for us, by the way.
So you talked about digital transformation, obviously key area of the company. What you mentioned, the cloud. Are there other technologies that you're seeing where you're seeing that demand when it comes to the whole digital transformation? And maybe what have you observed over the last year when it comes to COVID that is accelerating some of that transformation in certain areas of business? And maybe are you seeing a deceleration because of the customer segments and their impact related to COVID?
Yeah, no, great question. I think that the first area that everybody's seen, and it's not slowing down, is anything to do with the remote working from home, teleworking. So all the technologies around that and the enabling infrastructure for that is still in very high demand. We've seen a lot of customers do the move, others who did temporary shifts to be able to do that. So it's still a lot of work around that, and a lot of so the implications around that are all these technologies that support this. So even ERP cloud tools that enable that. Security is a big area of investment to make sure when you have all these people distributed all over the place, to make sure that they access everything in a secure fashion. And we're seeing a huge uptick in anything to do with ransomware and all these attacks. So again, everything to do around that to better protect and enable the users and the customers. We're seeing a big demand in that as well. So the other stuff that we're seeing demand, but it's really ancillary, is the big data, the data analytics, the AI around it. But for us, we do that, but it's still, I mean, the peripherals around the heavy lifting around really the platforms themselves. So we see a lot of demand around all of our ERP work, supply chain work, HR type systems, so stuff to better enable the employees and the customers, CRM. We're seeing a lot of work and demand around that.
Okay. And then OEMs and vendors in general, I guess as a means to capture margin, in some cases they're bypassing resellers, trying to distribute directly their products and services to the end customer. Are you guys seeing any of that encroachment in your business? Do you view that as a long-term threat to your business model?
Yeah, no, we're actually seeing the opposite. We're getting more and more referrals from the Microsofts of the world and the Oracles of the world, even though they have their own services practices. If you take it from their perspective, the margins on the software sales are a heck of a lot higher than the margins on the services side, even though we see very good margins on those types of businesses. Where they will get involved on the services side is when there's a very special request or something specialized or in an area they've never been before, or when there's a specific request from the customer to say, can you guys do this as well? But most of the time they actually prefer passing it on to us, just because one, they couldn't meet demand, and it fluctuates so much and it varies so much by industry that for them to be able to maintain, the practices in the different industries, I don't think would be viable in the long term. And they've tried. I mean, a lot of these companies have tried over the years to build up the services only to bring them back down. An example in Oracle in Canada, they shut down their public sector practice on the services side in the past year. So again, that was an opportunity for us to pick up some business there. So we're not seeing it in the big players. It might be something that people see more in the smaller niche type solutions, but in the heavy lifting and the bigger players that we're seeing, we're not actually seeing that. We're actually seeing the opposite, where they're calling us and sending business our way when they come across bigger projects.
Okay. So moving on to product, services, and strategy discussion.
Yep.
Obviously, you guys are, I'd say, industry leaders when it comes to gross margins. Can you speak to what is it a function when you tackle that? Is it a function of getting those margins because you're more prudent on cost management, or is it a function of a premium pricing? And if it's the latter, what's the value add proposition that you are delivering that customers are acknowledging and they're willing to pay you for?
Yeah, that's a great question, Nick. It's been part of our strategy all along to get away from the low margin work to the higher margin stuff. The customers will come to us typically because of a very specific industry skill set, right? So for example, on the ERP side, if I look at our Oracle business, we're the number one player in healthcare in the US. So if you're a hospital, you want to roll out the Oracle suite in a hospital, we're the number one player in there. So we get calls from customers from Oracle to say, listen, who would you recommend? And we're at the top of the list. In Microsoft, the same thing. So we'll be in the process manufacturing, chemicals, food, agri-food, like a Costco in the US, for example. And whenever they sell a turkey, the turkey that's on their shelf comes from their own turkey factories. They hold the whole chain. They use our systems. We implemented that and maintained that. So Good Foods is another example. They was a greenfield. They wanted to have the best solution for the food distribution, whatever. Again, they picked us. So we've rolled out the Microsoft solution there. So because we're specialized, we're in the top 1% of providers, we win because they know we'll be able to do the job and deliver it and deliver the value. And that's why we can go get those higher rates or the exclusivity that we have that gives us a huge edge on some of our competitors who say, well, we're cheaper, but we've never done it before. Whereas we can say, well, we can guarantee we're going to deliver it, and we can tell them exactly how much it's going to cost, how long it's going to take. We have the templates to be able to do it faster than the others, and we have a great reference list to show them. So that makes a huge difference, and that's really where we've been driving the company. Our acquisitions have been in that direction as well, of making sure we add in the pieces that we don't have, and that's what we're going to keep on doing. And yeah, our objective is to be up there with the leaders in terms of gross margins, because we know if we're there with scale, the rest is going to follow. The net margins are going to follow.
Okay, and then talk about proprietary products. I believe you've introduced some of those in the past, and then those are certainly good drivers of higher margin. So speak to what the reception has been in the marketplace when you've introduced a proprietary product, and also maybe just give us some insight into what products you have that you're planning in the near future, and maybe some market opportunities that you are trying to address where you see deficiencies.
Yeah, no, that's a good question. So we believe in IP as tools to accelerate what we do, and to your point, improve margins, open up new accounts. We're very selective in the type of IP that we want to sell. We don't want to be in the we don't want to be competing with Microsoft and some of these other businesses. So it's usually very specific, and it's something that will enable our existing customers or get us into a new customer. A good example is one that we launched a few weeks ago. We acquired a company over a year ago called Esquita that had automated testing tools. So we leveraged that skill, which we sell to customers, and looked at our existing customers and says, there's something we can do with this. And again, I'll use Oracle as the example, is when you implement an ERP system, especially with these new cloud-based systems, every quarter, you get pushed an update from the company. So Oracle every quarter sends out an update to this that every customer has to put in place, and it's mandatory. They give you maybe like a 1 quarter grace, but you have to do it. And every time you touch, people on your call would appreciate this. Every time you touch your financial systems, you got to retest everything to make sure you didn't break anything, especially if you're a public company and you have, Sarbanes-Oxley or 52109s or whatever. You have to certify, what's coming out of your system. You got to retest everything. It was very demanding for our customers and other users of ERP systems to do that every time. We said, listen, we have a tool. We know how to do these systems. We did it for ourselves. Let's use our own back office as a lab. We reconfigured the tool. We produced the tool to automate testing for these ERP systems. So we repackaged it, we branded it, and we're now selling it. So basically, our existing customers can now save days. They go from testing this stuff with a lot of people, a lot of days, to hours by automating the testing. And not only have we been able to sell it to our existing customers, but it's opened doors with other customers that use the solution. So we see it as a great door opener, a good thing to improve margins. And over time, our intent is to have a lot more of these types of IP that we can cross sell to our customers.
Okay, so you touched upon the word cross sell.
Mm-hmm.
Obviously, M&A is part of your strategy, but so is organic growth. Mm-hmm. What drivers do you see or are you pulling on to drive sustainable organic growth? Because I think that's certainly something that investors always take lots of pleasure in.
So people have been following us, but they'll be happy to know that even in our industry, that's been was really tough. The past year was really difficult in our industry in terms of organic growth. A lot of the big companies we compare ourselves against that negative growth. We actually generated positive organic growth this past year, and we're not seeing it slowing down. And I think it has a lot to do with the areas on your first question where we're focused on. So we're really focused on the newer technologies and the digital transformation piece and moving to the cloud, which we, first quarter of the pandemic, like everybody else, we had no idea what was going to happen. We took a lot of measures to protect ourselves, but we rapidly saw it taking off. And a good example of where we've been able to cross sell and generate more organic growth. And it's funny because we just basically released the press release this morning that we completed the project. But one of our recent acquisitions over a year ago was just over a year ago, was called Traversant, which was a US-based company specializing in healthcare. I mentioned about earlier. We specialize on the financial system side. A huge hospital group in the US called Nemours. Basically, if you would think of the sick children's or sick kids hospital in Toronto, multiply that by 5. So this group had 8 hospitals across the states, hundreds of clinics. And the company we acquired weren't even invited to bid on doing the project. And the minute we closed, we actually went back to the hospital because we knew they were going into a process. We not only got re-invited, but we won, and we won against some of the big industry players. And that was over a year ago. We just went live this week. It was a press release on it this morning. They're very happy. And when we won it, it was the biggest project that we won in terms of ERP, EPM, HR, the whole suite of the cloud solutions for these hospitals. And it was the biggest project. And the company we acquired they weren't even invited to bid on it, so they couldn't have won it alone. We didn't have the skills to do it. It was a great example of cross-selling. It was a $9 million project. A company that we acquired had like $12 million in revenue when we acquired it. So that single project was almost as big as the whole revenue of the company. So that company alone, since we bought it, that practice, we've doubled it in a year. So to me, those are great examples of areas where, because of our scale, when we add these companies that bring in a niche offering, high value, that we know we can accelerate the growth of. So that goes right into leveraging these acquisitions for organic growth, which we love.
Okay. And then obviously in North America, the plan is to become the digital transformation leader. I think you alluded to that earlier.
Yeah.
What's the outlook when it comes to Europe and growing that footprint? What's the strategy on that front?
So we're already present in Europe today. I've lived in the US for 12 years, Canada, I've lived and worked in Europe. The opportunities here, like a stone throws away, are so tremendous that if you look in terms of our capital and where we want to deploy our capital, it makes a lot more sense to look locally here, where there's cross leverage and same time zone, and I can get on a plane and be in New York in an hour. Going to Europe is a long trek. We're in a relationship business, so the closer our people are to the customers, the easier it is. So we've stated our strategy for the next few years is to grow North America. It's a huge market. I mean, we're just at the tip of the iceberg. We've got a great offering that's differentiated. We know we can win. We just need more scale and more of these niche offerings that we can help. We'll get to Europe eventually. It'll probably be that we'll buy something in North America that'll have operations in Europe that we'll keep. So, but in the short term, we're not targeting Europe as a focus area. It'll come eventually, but there's just too much here to do that be worth going over there for now.
Okay. So now moving to M&A, before we get into some questions around the R3D acquisition, just I guess going into that acquisition, coming out of that acquisition, big picture, what sort of services, products are you looking to add, and specifically turning to the M&A market to help fill those gaps?
So yeah, great question. So we have a pretty detailed roadmap of where we want to go. The original source of our information is our customers. So we look at our existing customer set, what do they need, and basically pick and choose and try to fill in the blanks. So we know from a back office perspective, when you look at mission critical systems for our customers, the top 3 packages, solution suites they're looking at are Microsoft, Oracle, and SAP. We don't have SAP today, so that's definitely an area we want to get into. Even within Oracle and Microsoft, we're big in certain verticals. We want to be big in all of our verticals. So again, it's picking these niche companies that are very good in financial services, for example, or energy, or some of these areas that we know we're good at in another area, and we want to add those things. So we have those on the list. We're very active in looking at all kinds of targets. There was a slowdown at the beginning of the year last year because of COVID, when a lot of people put a lot of projects on hold. Those have restarted. project like R3D was very complex. So it took us a while to get it done with a number of investors and people involved. It was significant. And the long-term agreements too were very complicated agreements to negotiate, because those are guaranteed agreements for the next 10 years, which you don't see much of anymore. So that was very complicated, but we're seeing we have a lot of targets. They're very active on the market, and we're seeing the multiples are all over the place, but we've been able to be to stick to our discipline and our approach. And typically the companies we've acquired or the companies we go after, we're not the ones paying the most. I mean, very often the companies that tend to stick with us have a higher offer somewhere else, but they like our model, our culture. They want to stick around. They want to be part of the story. So we very often say no to some targets when when the people want to leave. They just want to cash out and get out of the business. Those aren't the types of companies that we look for at the moment. So we've been able to find the right ones with the right fit, and that's why the integrations go so well and so fast, is because of that.
Okay, so looking specifically at the R3D acquisition, just maybe remind us what expertise that transaction brought to the table. What sort of cross-selling opportunities do you see with it, and maybe if you can even quantify or highlight areas where you see cost consolidation opportunities?
So the first obvious cross-selling opportunities was with their existing investors, so the owners of the company. So basically, in a nutshell, what we have is $100 million of business coming our way per year, 60 million of which is guaranteed, and these are market rates. So it's not a cost plus cap deal where we can only make so much. Here, there's no limit. They have to get, so the ramp up we said would be 12 to 24 months on the newer part of the business, which is about 35 million bucks. We already have between 60 and 65 million dollars of revenue coming from the acquisition, and at the full run rate at $100 million, and again, it's a minimum. We're going to be running at between 12 and 14% EBITDA on that business. So it's exactly where we want to be strategically long term. And again, so we got this deal, and we paid 6 times EBITDA for this. If I look at the price of the stock when we closed the deal, which is, if you had a company tomorrow morning at $100 million in revenue and 15% EBITDA guaranteed for 10 years, the valuation of that company would be outrageous. And we announced it. I'm not sure the market understands the deal yet, because if I look at the stock price, which it hasn't moved or gone down since we've announced it, I think we still have a lot of explaining to do around that one. In terms of services that they do, very similar to us, was high-end consulting, digital projects. They had a development center that specialized in e-business, e-commerce type projects. They called it the studio, which fits really well with our digital center. And yeah, of course, the back office synergies. To give you an example, just on real estate, we got like $1.5 million of savings that putting the two teams together. So that's not counting all of these synergies we're going to have in the back office of that company, which we've already identified. The people have already been told. The people sticking around for the transition have their transition package. We've been very transparent with the people. It's gone very well. We actually transitioned the people in the first weekend. Everybody's on our systems. Everybody's has our Alithya email. The websites have been brought over. The teams have been integrated. We've worked for so long on that project that the integration was very well planned and is going very fast. So we're pretty happy with that one.
So you touched on something that was going to be my next question, and I will ask it as a means to give you the microphone and maybe explain to investors that are on the line. When you announced the R3D acquisition, I certainly had the ticker up. Noticed, I think at one point you were up 40% on the day, and when I look at since then, it's been share price has been very volatile.
Yeah,
you're still in the positive territory, but more in the single digit range. When you look at the value creation that drove the rationale for the transaction. What do you think is the and explain to the investors, what are they missing? What do you think that they maybe haven't gotten, or they're still just mulling over?
If I went back at 20 years, I'd say look at the CGI Bell deal. When that first deal was announced, people at the beginning, people didn't understand it very well. It took like a quarter for people to actually see the numbers. So since we closed it April 1st, which is the beginning of our fiscal year, so before we report the first quarter, we're going to be in August timeframe. So unfortunately, I think a lot of people are going to wait to see what happens by then. And by then they'll see the additional revenue that came from that acquisition and the deal and the ramp up of the deal and where we're at. And somebody's going to wake up and say, holy shit, I missed something. And I think people don't understand the 10-year guarantee. I mean, if the ramp up doesn't happen, the customers cut us a check. I mean, it's a really good deal where, I mean, you don't see it in the industry anymore. These 10-year outsourcing type agreements don't exist. I mean, it's very short term. People can get out anytime they want. There are no guarantees or whatever. In this case, not only are there guarantees, but they're minimum guarantees. So I mean, to me, it's like buying an empty building, an empty 10-story building with a 1 million square foot versus buying one that has 10-year leases on every floor guaranteed. The value of those buildings are not the same. And for us, it's a game changer. Getting some recurring revenue guaranteed for the next 10 years is a huge game changer for us in terms of the type of business that we do. And especially given it's not maintenance type costs, low cost business you can send remotely to India. It's really digital transformation, on-site, new business, new project. We actually have to hire 350 people to meet demand for these new projects. So that's underway and very, very exciting.
Okay. And I think recently you made a statement that you want to double the size of the organization without diluting margins. The R3D transaction helps get you there partially. So what's the timeline for reaching your doubling goal, and how much of that doubling, now that you've done R3D, how much of that doubling is going to be organically driven, and maybe what kind of organic growth rate, and how much of that is going to be M&A driven?
Yeah, no, a great question. So, I mean, if you think about it, just running the numbers in my head, our run rate before R3D was around 300 million. So you're going to add 100 million with R3D alone. So, I mean, that pushes the run rate to close to 400 once we're fully ramped up there. We usually target a organic growth rate of between 5 and 10%, just because we're focused on the digital transformation side. So even though the Gartner is predicting like 1% growth of the IT budget, we know we can do better. So that would take us to maybe 450, 480 over 2 years. So it means if we want to get there within the next 3 years, we got to do another 150 million dollars worth of acquisitions. So it's probably going to be about 50-50 given where we're at. Maybe a bit more from the organic. We'll see. There's a lot of nice opportunities for acquisitions out there of nice companies that are struggling with critical mass. They have a great offering. They're seen as like the best in the market, but because of their scale and size, they can't go after the big projects. So they end up being subcontractors to some of the big four. We'd much rather have them on our side and go direct, right? So that story appeals to them. So if we can get there faster with more acquisitions, we will. We just want to make sure that they can be easily integrated. And to your point, they're accretive. So as long as we can stick to our model, we're very disciplined. So as long as we can stick to our model and make them accretive, we'll do more if we can and get there faster. But we believe next 2-3 years we'll be there.
Okay. And you touched on something that leads me to my next question, which is when you look at yourselves, I see you guys as buying the finished home, right? No need to renovate, and you look to drive business forward, whereas some of your other competitors, they like to buy the fixer upper.
Yeah.
when now you alluded to there are some, you see companies out there that are attractive from from an acquisition perspective, which leads me to think that there is willing sellers out there. But you also alluded to the fact that they're struggling. Is there something like an area of what's driving their struggle? Obviously, I'm assuming COVID is part of that, but is there an area of concentration that's driving that struggle? And are these companies that you would like to acquire, or do they require, because of their struggles, some of that painting of the walls that you might not want to do?
Yeah, it's an interesting question, and maybe the word struggle is the wrong word that I use, but it's they're facing what I would call like a glass ceiling, right? In that because of their scale, they're very good. They get a lot of business, but they're growing at 10, 15, 20% because they're limited in the size of projects that they could go after. Traversant is a good example. If I look at their run rate today versus when we acquired them, they've doubled because we've been able to go after bigger projects, which they couldn't do on their own before. So even though they were successful, they had good margins and they were doing well, they saw that they were getting to a size where if they didn't do something, they would be, kind of kept out of the bigger, more strategic projects. And in our business, especially for us, where we're going after digital transformation, and I can say this because I'm a computer engineer, we hire geeks. I mean, people who come to work for us, they want cool projects. Same with me. And if you're not growing, the projects aren't going to get any bigger. They're going to be smaller. And so these companies have the exact same issue. They've attracted people, they have cool projects, and they get to this ceiling where they need to take it to the next step. So then they're deciding, okay, do we go out and buy something? Do we merge with somebody? Do we, and a lot of them are at an age where they're saying, well, maybe we should take some money off the table, but we're far from over. We like what we're doing and we don't want to do more. So we offer them that opportunity. We offer them access to a bigger sandbox. We take away the back office pains of having to hire and manage the back office, whatever. And we say, go out there and sell. Go out there and get business, take care of your customers. We'll take care of the back office. So we've created this shared service back office that we can accommodate a multi-billion-dollar company. So we invested a lot of money in that. We've actually used it as our own test bed. We're one of the first companies in Canada to roll out the Oracle Cloud solution combined with the Microsoft CRM solution, which are two solutions that we actually sell and implement for customers. So it's great. We can use it internally, find the bugs, make it work, use it as a training ground for our own people, and then go out there and then cross sell this. So we there's a lot of nice companies out there that are at that that decision point. It's getting them at the right time. It's getting them at the right time.
And so my next question, you said at the right time, and obviously you'll agree
at the right price.
So on the price aspect, obviously with R3D paying 6 times, clearly that was the right price for you. Can you speak to what is your right price when you look at the marketplace? And also, what impact has the low interest rate environment had on valuations when it comes to private equity guys, maybe going out there and shopping and maybe driving up valuations to a level that you're not comfortable with?
We've all of our acquisitions, if you look back, we've done 11. We've done the 5 since going public 2 years ago. They've all been in the 5 to 7 times EBITDA range. The 7 times is usually because we see the cross-selling opportunity short term, or there's an obvious synergy that we know we'll get at the day we close. So we'll go a bit higher when that happens, but we're always in that range. We run into private equity and I would call strategic buyers a lot, much bigger companies. And typically they'll offer more. What we hear back from the companies that have come over is that the strategic buyers don't need them, right? They want the business, they don't want the leaders. And the private equities is similar. It's either they want to buy them and use them as their hub and tag on stuff to it. So the leaders there have to want to stick around. to do more of what they're doing and integrate companies, or they don't want them because they already have a company that's similar. They just want to get the market share and the customer base. Our approach is very different. So usually when they go for one of those two players, they go for more money, and it's because the guys or gals want to exit the business. That's not what we're looking for. So we qualify that right off the bat. When we look at companies, I mean, we have I joke about this, but it's true. We have three questions that we ask. Is one, why are you selling? If they say it's because they want to, they want to grow the business faster, they're looking for a partner, whatever, say, okay, check. Are you interested in sticking around? And if they say yes, we said, okay, check. If they say no, I mean, we leave. And the third one, it's usually the killer, is, are you interested in cash and stock? And if they say cash only, we know the first two answers were BS and that they want to leave anyways. So we don't want to compete in that area, and we have lots of targets with our own formula that we like. And we have a very happy seller who's on board after, who has a bigger responsibilities with less hassle. So we tend to have very happy shareholders after who want to grow the company.
Okay, so moving into, I think we got 4 minutes left. I'll try to get one, maybe two questions in, just general discussion. Is there parts of your business that you could qualify as lower value service offerings? And the one that comes to mind is IT staffing type services. Do you have those things in your mix today that you're contemplating selling off or just turning off for the purposes of driving further margins expansion?
Mm-hmm. No, that's a great question. We had a big chunk of it that we actually completely removed, which we call payrolling. This is when a customer says, listen, I have 100 people here, put them on your payroll and bill them back to me. It's not our core business. We do have some for some of our key customers, but it's managed outside. So it's not even in our revenue. We get we declare the net margin of that. It's managed separately. And we do it because some of these customers are strategic customers where we do a lot of the bigger projects, and they've asked us to do it. I guess we see it as a badge of honor, or a sign of trust that they would ask us to do that. We basically, process the payroll. It's not a business that we go after or a business that we want to get into. We manage it because the customers asked us to, but it's not in our long-term plan to grow that business at all. So yeah, there's a little bit of that, but it's much smaller than it was like 5 years ago before we started on this strategy.
Okay, and I guess one last question. Given the fact that you've got a consultancy-centered business model, how obviously you're hiring and retaining of quality employees is going to be a very critical component to the long-term success of the firm. What sort of incentives, strategy do you guys deploy to, at the end of the day, your people are your assets? What's the strategy to retain that?
Yeah, well, the first thing is what I was mentioning earlier. So the people in our industry want to work on cool projects, which again is driving the strategy, the overall strategy in terms of where we're going as a company, the type of projects that we want to do. That's the number one way to attract them. Keeping them is interesting. So my theory on that is, and if you look at any statistics out there, whether it's from Harvard or York or McGill or whoever produces the report on retention, 80% of employees, and it varies, 75, 80%, but it's in that ballpark of people leave companies because of their bosses. They'll join a company because of what they heard and what they want to do. They leave because they don't have a plan, they don't have a career, to me, they're all issues related to their immediate manager. They don't like, the bottom line is they don't get along with their boss, or they don't like their boss, or they don't look up to their boss. We rolled out 3 years ago, based on that, our Alithya Leadership Academy. So we created a very specialized training with the McGill University for all of our leaders. They've all been through it, whether they're in the US, in France, in Canada, French, English, whatever. They've all been, it lasts a full year, and it's really on having better leaders. So how to better communicate, how to better manage your people, how to manage performance, how to create value. So these are all things centered on the individuals, and some people call it soft skills. I call it human skills. It's really on how to be better at what they do. The difference has been incredible since we started that. We use it as an integration tool when people get promoted, and we actually measure it. So at the same time as we rolled that out, we rolled out a tool called Office Vibe. It's a Montreal company called GSoft. They were in the news recently. Very nice company. Tool is incredible. I know a lot of companies use it now around the world, where we measure real time, all the time, the feedback from our people. And it used to be you do once a year, you do this big employee survey, whatever. You do it after annual bonuses. Everybody's happy. And then you get a report 3 months later. It takes you 3 months to figure out what to do. And then by the time you're done rolling out a plan, you start over again. Now we have it real time. Every day I have access on my computer to exactly the pulse of everybody in the company, how we're doing. And we measure all these criteria. The criteria that we have that is the highest KPI of everything that we measure since we started the academy is the relationship between the employee and their manager. And to me, that one's the key. If we can get that one right, everything else follows. And it's amazing. The retention rate has improved. Everything's improved around that. So we're really focusing a lot of effort on that. Even during the pandemic where we couldn't do it in person anymore, we rolled it out virtually. It's different, but it's still working. And to me, that's an area that we're going to keep investing in. And again, if we have the best leaders, we're going to attract the best people and hang on to them. So to me, it's a combination of those two things.
Okay. Appreciate that. That's all the time we have. So we're going to conclude this conversation here. Paul, thank you for your time and
thank you for the invitation. It's fun.
It's been a pleasure. And everyone that is on the line that certainly has joined us through the course of the day, I want to thank everyone for attending our event today. We do have one more day tomorrow in real estate land. And I'll leave it there, and I'll say to everyone in the audience, stay safe. Thank you.